So before we move on to using some of these tools in Python to play around with data, right? I think a bit of understanding of some statistical concepts is good, right? So we are going to go through that. We're going to go through explaining what mean, variance, covariance, correlation, and all those things are, right? And what better way to sort of explain some of these things than doing it in the context of say money, right? And I'm not sure how many of you guys are into watching what the stock market is doing or what the bond market is doing, right? So, but at some point, when you have a little bit of savings to deploy, you need to sort of understand some of these concepts to sort of participate. Okay, so by being exposed to the capital markets, you are in a way participating in the growth of capitalism, right? And in a way you have to be part of the system, right? And the system rewards, uh, fortunately or unfortunately, the system rewards owners of capital, right? Owners of assets, okay, in our economy, in our globalized economy, right? So you have to sort of participate in that, okay. So back in 1952, Harry Markowitz, I think he published a paper in the Journal of Finance, okay, and he sort of laid out a framework around how portfolio management should be done, right? And it came to be known about as modern portfolio theory, and I think around like if like that paper basically won him a Nobel Prize in economics about 4 decades later, right? So it went sort of unnoticed for like 40 some odd years, and suddenly the world of money management sort of caught on, okay, and started exploring and started using some of these concepts, right? It's not a foolproof concepts, but it's a good way to go through this and try to understand the statistics behind it, which which more or less will help us in the rest of the course, right? So uh, so the basic idea was designing diversified portfolios, okay. Diversified portfolios with uncorrelated asset classes. Uncorrelated means, and that's right there. That right there we are going to explore a little bit of the math behind it, right? What is correlation? What is covariance, and so on, so right? And the title is Mean Variance Optimization. So you know that we are going to talk about mean, which is an average, which are averages. Variance is basically the spread around that average. Okay, and uh, so when he was writing this paper, he was writing it in the context of building a portfolio of say 10 different companies or 10 different stocks, right? So when you go out in the market, on the stock market, and say you buy stakes in 10 different companies, regardless of how small they are, you basically become an owner, part owner of those companies as a shareholder, right? So basically you participate, okay, in the growth of capitalism when you own a lot of these companies, right? So basically the idea uh, is to become an owner of assets, right? In our globally connected economy, you want to participate in it, and that is one way to do it, okay. So either you what I try to say is that either you start your own company, or you start your own business, okay, or buy a stake in someone else's business, and that's what you're doing by investing through the capital markets, right? So the original idea was behind, like say, building a portfolio around say 10 companies, right? But I don't think in today's day and age, I'm not sure what you're reading about, but I think entire sectors and entire industries can actually go out of business, right? Because of disruptions and globalization, and all the other things which are happening in this rapidly evolving world, right? So you don't want to over concentrate into a few investments, right? So that's when we're going to start talking about asset classes, okay? Asset classes are basically a type of investment, right? For example, let's look at this data set, okay? So what I'm trying to say is that buying say 10 different technology companies or 10 different oil companies is not diversification, right? Because the entire sector can technically blow up, right? But if you diversify smartly, right, that means if you own assets which are spread out amongst different types of investments across countries, uh, you are likely to be okay, right? And that's the goal. Okay, so let's. By the way, we this part of code. So there is a little bit of code. So by the way, this might look a little bit different to you if you have never been exposed to something called a Jupyter notebook, which you're going to work on a lot as the course progresses, right? But I'm just giving you a flavor, right? So this is a notebook where you can write code, you can display plots and everything, right? So this basically is the format we will be using for the rest of the course, right? So let's start with this small data set, okay? So just imagine, right? We talk about big data and so, right? But look at how small this data set is, and look at the amount of stuff you can do with it, right? If you know what you're doing, right? So it's not the size of the data which is going to make a difference. It's what you need to do the work you want to do, right? So this data set is basically this is annualized returns data. That means what that category of investment did in a given year, right? So if you look at it, it goes from 1970. I think it stops at 2018. I think I came across this data set in this one of the magazines I was looking at, and I thought I'll use that data for this example here, where I can also explore some of the other statistical concepts. Okay, so just to go through a little bit of this thing. So you have large US equity. Okay, that means you have big companies in which are traded in the US on the US stock exchange, right? So it could be Microsoft, Apple, Google, and so, right? Then you have small companies in this country, which is US. Okay, then you have companies which are outside the US in this basket. Okay, so these are all baskets. Okay, then you have bonds. Okay, bonds is when you basically lend money to businesses, right, or government in some cases. Okay, then you have cash as an asset class. Okay, so these are, by the way, these are all groups of companies which are then packaged into something you can buy on the stock exchange. So they are called asset classes, right? And if you want to know more about it, and if you want to sort of find out how to sort of buy and what to buy, maybe we can talk about it at a different time. Okay, but this is not an investment course, though I guess we are going to talk about making money and all. This is more about knowing the statistics and the math behind exploring data, right? So that's what we're going to do. REITs is basically real estate investment trust, where you sort of become owners in apartment complexes through the stock exchange, right? Apartment complexes, shopping malls, and all. So I'm not sure what you are hearing and reading about, but there is a big thing going on in the REIT space with this pandemic we are sort of enduring through, where the expectation is that a lot of these companies which are exposed to real estate, like office space, like shopping malls, like movie theaters, they might not survive. Okay, and that there is a logical reason behind it. If the companies have overstretched in terms of borrowing a lot of money to expand, right? And who would have known, right? Who would have known that the situation will be this dire? But we'll see how that and that's the nature of investing, right? In investing, if you don't diversify, if you over concentrate, let's say all your money was tied up into owning a shopping mall, right? And suddenly this pandemic hits, the tenants cannot afford to pay, and you have this huge mortgage you are paying. Probably you borrowed money to buy that by that mall, right? Then you probably can run out of money very quick, and you're out of business, right? So something like that, right? So, and I already explored here. Okay, REIT is basically buying real estate, investing in real estate. Okay, and then there is this last segment called commodities. So we're going to look at this different uh, asset categories. We're going to sort of try to create a portfolio around this seven different types of investments and see which portfolio does the best over a long period of time, at least across this time frame. Okay. Now, one thing you have to remember is that this is not a lot of data, right? So that means, and I think we talked about it, and we're going to talk about it more, right? But whenever you're dealing with data, you are always going to be dealing with samples, right? Because you will never know the full spectrum of what the population looks like. Okay, and when I say population, right, in this context, what you are talking about is knowing the returns of not only the returns of say large U.S. equity in the past, but all the returns out in the future as well, right? So you don't have that data, right? It's impossible to have that data now because the future is not knowable, right? So whenever you're looking at a snapshot of time, you're basically looking at sample data, right? So okay, so so why can't we do the same thing with say individual companies instead of say looking at a basket of companies, right? So when I say large USA equity, it could have like say 5,000 companies, or sorry, 3,000 companies, or 2,000 companies, or whatever it is, right? I think at last count there are probably 3,500 publicly traded companies in this country, right? Some of them are going to be in small category, some of them are large, and so, right? So let's say 1,000 of them, or maybe say 500 of them are big companies. The remaining are small companies, right? So why can't we just do the same thing with say, and I'm not sure how many of you are familiar with Dow Jones, right? Dow Jones is what gets reported every morning. Say you wake up and you watch the news. If the market is crashing, you'll say, oh, Dow Jones dropped by this much, and Nasdaq did this, and so, right? But Dow Jones is only a collection of 30 companies, right? And that 30 companies technically represents what American economy is, right? So at least the public side of that economy, right? And that's how. So there is a committee in Dow Jones which sort of gets together and decides on which company should be part of that index, right? So if you look back in 1970, and if you look at the makeup of Dow Jones in 1970 versus 2018, right? And let's say you wanted to sort of build a portfolio and just sleep on it and never look at it, okay? You will see that the construction or the index, basically the structure of that company has, the index has changed, right? Like a lot of these companies don't even exist. Okay, imagine owning Sears. Okay, imagine owning Sears now, right? You will probably lose almost all your wealth, right? Chrysler, right? I don't know how many times it has gone through bankruptcy and all those things, right? Just because a company exists doesn't mean that the stock exists through this time, right? Because when a company goes through bankruptcy proceedings, the stockholders and the bondholders typically get wiped out, right? And it's a new stock from that point on, right? Union Carbide and all this, Eastman Kodak, right, is another example, right? So if you created this portfolio and you slept and you woke up, say, in 2018, you might not be doing as well as if you had basically constantly moved in and redo your portfolio again, okay, every few years, right? And that's the nature of the game. So you cannot just buy something and sleep on it, right? Or you could have bought. Now, instead of buying these companies, if you would have just bought the Dow, right, you probably did okay, right? Because see, even though the structure of the companies changed, because you were basically owning Dow as an index, when the structure changed, they changed the companies within that index, right? So you still went from 800 points in 1970 to 26,000 points today, right? And that doesn't even factor in dividends, right? Dividends is basically a return of your the profits uh, that this company give out routinely, right? So you did pretty well owning Dow, but if you had basically had a static portfolio designed around all this statistical math you did, mean variance optimization and all, you probably would not be doing as well, right? So that's some of the reasons why we are going to look at asset class, okay, which is called this bunch of sectors instead of looking at individual companies to create this these good portfolios which can technically carry you from when you start to work until retirement, right, and probably beyond that, right? So that's a little bit of overview of what we are going to do. Let's move on to some of the nicer things. Okay. Okay.